So hi all, welcome to today's session on domain training, and today we'll be continuing on stocks and shares, okay, and the terminologies, basic terminologies we have there, okay. So well, before we start, are you able to hear me well? Fine, fine, Arti? Okay, okay. Now, say suppose, okay, we discussed on multiple investment options like bonds, FDs, RDs, savings, etc. Right? Now today we'll discuss on something called as stocks. I'm not a great trader though, but a few of the concepts I'll let you know. Okay, not maybe not all the technical terms, but few basic jargons which will run into the stock markets. We'll let you know. Okay. Now, say suppose we were discussing about the investment banking in the last class, where if any company want to have if any company want to grow and they want to expand, they will go for bonds, right, and debentures. Instead of that, there's another option called as shares. Okay, what is this will do for the company as well as the investors is it gives an opportunity to gain or lose. Okay, so how does this happen? This is a big chain, or this is a big topic on a whole. Say suppose I have a company ABC and it is doing a business of 50 crores per annum. This is company's revenue. Now after tax, the profit is called as, which is called as PAT, profit after taxation, is 2 crores. Okay. Now the company ABC has a plan to expand and to grow to a level where its revenues will shoot up 10 times. Okay. Now, in any business terminologies, any company whose revenue is somewhere near some 50 crores, they will have their net worth, okay, defined. Any company will go for net worth definition. In the sense, I have a company. Say suppose let's take Amazon itself. Amazon might be doing a business of 2,500 crores or 3,000 crores in a year, but its net worth will be calculated in a different way. It would be way above than 3,000 crores. It would be somewhere near 40 to 50,000 crores net worth. The reason being, right, there's a lot that goes in defining the net worth. In the sense, in future, considering the type of business, the nichiness of the business. One second. Considering the type of business, the customer base, and so on and so forth, the uh, companies will be evaluated, okay, and they will be given some net worth, okay, which means they are increasing the value, they are defining the value of that particular company. So my this company ABC's net worth is defined as, say, 500 crores, okay. So after that now this company ABC want to go for an expansion, and it needs another 20 crores to make itself ready to become a 500 crore organization. Obviously, right? It's as simple as that. Unless you take domain training, unless you take domain training. Hello, Ram, can you hear me? So now this organization want to jumpstart from a 50 crore organization to 500 crore organization. So how will it do it? It has to invest something on the infrastructure or the expansion plans so that it can go to the next level. It is as simple as this. You are a manual tester and would want to add some skills. Then only you can go ahead in career, right? Which means you will get more money and so on and so forth. Similarly, even for an organization to go to next step, it needs some money. So it can either go for bonds or debentures, or there's another concept called as stocks. Now, this is a beautiful concept where it will help the general investors or the normal investors who are interested only to pool money, which means these investors will only pool money but will not involve in day-to-day activities of the company, right? Whereas a partner will be actively involved in the company's general maintenance or expansion plans, and will be looking into the day-to-day activities, and so the expectations of profits will be more. Whereas here, right, I am giving this investors will be investing the money into the company and will be expecting the profits that come out of this investment that is made. So say suppose, as I said, 20 crores is the need for the company. Now 20 crores they are pulling from investors. How much is it? 20 crores. Now company will decide that, hey, this 20 crores will be invested in so and so areas of the business, and whatever is the profit that is earned because of that investment will be equally divided. So for that, it has to be well defined earlier. So what will they do? They will say, uh, and they will say a share or a stock worth 200 rupees will be provided for. So for 20 crores, each stock at 200 rupees, how much will be the number of stocks? It would be somewhere around 2 lakhs, right? 2 lakh, sorry, 1 lakh, 1 lakh stocks into 200 is 2 lakhs, 20 lakhs, sorry. It would be 10 lakhs stocks, right? So 10 lakh stocks will be on sale. Okay. Now this 10 lakh stocks worth each 200 rupees will be out there in the market. It's as simple as that. I am buying a chocolate for 5 rupees. How was it defined? the company defined based on the expenses that are incurred and the profit that they want to earn from it, right? Similarly, they are setting a standard that we will provide 10 lakh stocks to the investors. Each stock is worth 200 rupees. Now, any person can buy, okay, 1 to 10 lakh shares, these shares. So generally if a person is buying, again there's a lot going into it. Where is the investment coming from? Is it a single owner kind of thing? So generally a single person may or may not be buying this 10 lakh shares. Now how does this happen in the back end? So there's a concept called as 51-49%. Okay, so 51 will be the company owner or the consortium. In the sense, the group of people who started this company, they will be the major owner. So now this 20 crores or the total worth will be divided like 51, that's the maximum, to 100%. Okay, but generally 100% will not happen because if it is 100%, they cannot go to the stock market, right? I mean, they don't need any other investors. So it would be less than 100%, obviously, right? Could relate what I'm saying, Aarti? So a company share will be somewhere between 51 to 99%. The reason being they should be the primary owner, right? So the rest 49% will be open to the investors. Aarti, any confusion? I'm unmuting you. Let me. If you would like to speak, you can speak, okay? Alright. So coming back, so now this 10 lakh shares of, 220 crore shares will be equally divided, and that particular investment will be only 49% of total investment done by the company, right? This 20 crores, say suppose only 10,000 members have bought. So each on an average divided by each have bought something worth about 20,000 now, right? So 20,000 into 10,000 is near to 20 crores. So that's the amount of investment that is done. So this is called as stock or securities. Right? Ram, welcome back. Sorry, there was a power failure, so I couldn't. It got disconnected. So any company or what do you say, any organization will go for the stock options, and it will provide to the general investors. Now this particular stock option will be bought by the general investors, and then once the profit is incurred, it will be shared based on the investment done. So this altogether is a big topic. I don't want to confuse you guys more. Okay. So generally, for your understanding, a stock or security is something where the normal investors can will pull those, will invest that amount into the company, and whatever is the profit that would be shared based on the investment done. Okay. So on 20 crores, say suppose investment, first year company earned 20 crores as profit after tax. So this will have to be equally distributed among all the investors. So how many investors are there? 10,000 investors. Okay, worth to 20,000, which is let's not confuse you more. So 10 lakh stocks are there, right? So 10 lakh stocks were 200 crores. Sorry, 20 crores. Now it got increased to how much? 40 crores. 20 plus 20 profit, right? So 40 crores. Now what is the net worth of the stock now? 40 crores divided by 10 lakh shares, which is now 400 rupees, right? So when it was given to the investors, it was just 200. Now after the profit, it is increased to 400 crores. Sorry, 400 rupees, which means the amount is doubled. So this happened in just one year, right? So what is the return on investment? That's almost 100%. That's so not almost. That is 100%. So this is my ROI. Whereas if I invest in savings, what would be my return on investment? It would be 8% to 13%, right? That's my maximum return on interest that I'll be in. But in this case, I got 100%. This is a very positive scenario. There might be situations where company might be going into loss and it might end up with 10 crores. So it lost around 10 crores of the 20 crores that is invested, which means now the stock will go down to 100 rupees, right? So you got the calculation, right? How is it done? So my investment was 20 crores. I had a loss of 10 crores. Okay, which means my net investment now is only just 10 crores. I have 10 lakh shares, so 10 crores divided by 10 lakh shares is how much? It's just 100 rupees, right? So that's how the stock price is calculated. All right, now there's another concept called as ESOP. Okay, ESOP is a beautiful thing which is provided to the employees working in the organization, okay, or the investors. Okay, so what is this? How is it different to the shares or the stocks? It's simple. ESOPs are given to the generally to the shareholder. Sorry, in given to the employees or the company partners. Okay, or the board members as an incentive at lesser price than market price. Okay, these can be to anyone. It can be to anyone who are having what do you say, who the board members or the organization has defined. Okay, this is generally to the it's giving as it is giving to the it is given to the employees so that they will feel that it's their organization, or what do you say, it's just like an offering to the employees, okay, or the partners in the particular organization. Now how is it different to the normal stocks? Okay, shares and ESOPs are on the paper one and same, but the only difference is there are a lot of restrictions on ESOPs sales and buying. So no one, beyond the limit, no one can give more ESOPs to the employees. The reason being, right, this is concept called as insider trading. Okay, so say suppose a company ABC, the same company ABC is there, and it is coming up with a product which will be giving a boost to the sales, and the profit will increase or jump threefold or fourfold. Now that particular information, if the particular the employees in the organization will obviously know about that particular product. So what they will do, they can buy more stocks from the market and will keep it, and once the profit comes they will sell it. Now what is it happening? These 10 lakh shares are circulated among the investors, right? So when we discussed, we had 10 lakh shares, right? Only these 10 lakh shares will be there. The number of shares will not increase, right? So these amount, the count of shares is fixed, right? So what is it happening? If the employee knows of that organization knows that the product will be hit and it can earn some profit, like profit 100 crores in 2 years. So what will be the net worth of the investment that I have done, or that the investors are doing? Earlier it was 20 crores. After 2 years, 100 crores is added, which is 120 crores. So how many stocks are there? Divided by 10 lakh, which is 1200 rupees is net stock worth. How much was it earlier? It was just 200 rupees. Now it went to 1200. So this information was already known by employee. So he can buy from the market. Now what happens? Say suppose this employee has 10,000 shares and want to buy another 10,000. Company will not give these shares. These 10,000 shares will have to be pulled from other investor who want to sell, right? So unless if someone else want to sell, from them these 10,000 stocks will be there. So now when when the employee has bought, the share worth is 210 rupees. Okay. So the investor who is having 10,000 shares, he will think that, hey, I have 10 rupees profit. For me, it's fine. So he will sell those stocks. Now employee share count is 20,000 and the investor who sold will have 0. Okay. Now after 2 years, what is the employee share value? It's 1200, which is his investment is increased by 6 times, right? Now people may argue that's okay. What is wrong in it? If someone else is selling, it's his mistake, right? No, that's not ethical at all. This particular employee knew that this product will be increasing. That's the reason he bought it, which is unethical practice. Okay, so that's called as insider trading. Okay, so in order to curb this insider trading, ESOPs will come with a lot of restrictions. In the sense, employee cannot buy the shares without the consent of board members, or in terms the company and the regulatory body. Okay, in US it is a NASDAQ. In India it is SEBI. Okay, so that's how ESOPs are different to the normal shares. Okay, so there's a lot of restrictions. I'll share a document which will differentiate what is a share and what is a ESOP. I mean, what are the restrictions that goes into it. Okay, so far any questions? Any questions, Ram? Arti? All right, I don't see any questions. Okay. Now, so coming back, before these stocks or investments or ESOPs are given, right? There's something called as IPO, which is initial public offering. Okay. Now, when we discussed about ABC, its net stock worth is 200 rupees, right? Initially for 20 crores. Now, it has to go into the market. So how will they define that these many stocks will be there and each stock will be worth of 20 crores? How will they define? There's a lot of process that goes into it. Okay. So that is a big topic. We cannot, I mean, just to information, it is calculated based on the revenues, the valuation of the company, and the estimates of profits that are going to come in in the future. Now, company has said that the business organization has said that my stock worth would be 200 rupees, and this is the amount of these many stocks will be given to the market. Now that's called as IPO, initial public offering. Now investors have an option to buy these at the price offered by business. So in the case of ABC, it is 200. Now, when it goes into live, right, that's IPO. People or the investors think that hey, this company is worth more than that, and it can go till 500 rupees in a span of 3 months. So what they will do, they will buy these stocks pre-IPO and will keep them. Okay, so now what's the advantage for an organization wise? It is building the image, okay, or the brand, okay, saying that hey, see, these many of people have bought the shares well before the IPO itself, and it's in boom. So what will happen? There can be more and more investors who will be coming. All right. So that's one way. The other way is for investors' point, they are buying stock at basic valuation. The base valuation, I mean the minimal valuation that is being given, investors buying that, right? So when they see that it can go to 500 rupees in a span of 3 months, they got this stock at dead cheap for 200 only, because it was basic, the valuation was basic and the share price was defined like that. So if it goes to 500 in a span of 3 months, it's good for them, okay, and they can sell them off and can earn money. Now that's a disadvantage to the organization, right? Obviously, because in span of 3 months, they're earning 500 rupees, and they almost, it's double, more than double, 2.5 times, right? Which will be a loss to the business organization. So that's the reason they will hold this money till 6 months. That's the basic rule in any IPO. So stocks bought in IPO will be hold for 6 months. Only after 6 months investors can sell. So it's a mutual risk both the company as well as the investors are taking. Okay. All right. So that's in IPO. Now this, how all these shares and stocks will be there. There will be a common place where these activities happen. Okay, think like this. I have I mean there is a lot of vegetables, okay, and farmers grow them and they will have to sell, right? Now think in both terms. Invest the farmers, if they sell at their land, they may not get many customers. Okay, so there should be a common place where they can sell. So that's called as market. Think of the buyers who want to buy vegetables. So if they have to go to the respective farms to buy each is vegetable. So if you take tomatoes, potatoes, chilies, they will have to go to three different farms to buy them, which is a cost for them. Instead, if they go to a common place and can buy all these three at one shot, it's an advantage for them, right? So if you see both from traders and the both from the farmers as well as the traders as well as the buyers perspective, having a common place is an advantage for them. So that's called as marketplace. The same for multiple stocks of different organizations for buying and selling. If you want to have a common place, so that's called as stock exchange. Okay, so in India it is BSE or NSE. In US it is Nasdaq. In Japan it's Koppi, so on and so forth. Right? Hong Kong, Singapore. So they'll have their respective stock exchanges. Right? Now the basic rule is a citizen of the country can buy or sell the stocks in his or her base exchange. So base exchange is the country of the country where this particular citizen is staying. Now there are two concepts: uh, country of residence, country of origin. Right? So say suppose let's take example of Ram or Aarti itself. So your country of origin is India, whereas your country of residence is Canada or Switzerland. Now, can Aarti buy stocks in Switzerland? Yes, because she is resident of Switzerland and she has basic identity proof to show that her residence is in Switzerland. So unless and until you have a residential proof of that particular country, you cannot buy the stocks of the companies that are based out of that particular country. Now, can she buy Indian stocks in India Stock Exchange? Can she? Can she buy?
No.
No, right? Right? Because her country of residence, the basic point is it has to show the residence proof, right? So now she is not based out of India, she cannot buy. Okay, so for that there's a provision called as investors, foreign investors, FIIs. Okay, foreign for FDIs or for FIIs, which are called as foreign direct investors, FDI, foreign direct investments, where you anyone from the country other than the exchange can also buy in that particular exchange, showing some valid proofs as defined by the exchange. So it's the exchange which will define what sort of investors can invest into the stocks of that particular exchange and what's the duration, how much is the minimum time they will have to settle down in that particular exchange before they sell any of the stocks they brought. Okay, so that's the basic definition that will be done. So from testing point, what we have to see is the in India it's PAN card, whereas in US or Canada I think it's based on uh, SSN. Ram, am I right? How does it go in Canada?
Yeah. Yeah. SIM card.
SIM, no, not SIM card.
SIM card.
Oh, is it SIM card? Okay.
Yeah. SIM. SIM.
SIN. Okay.
Not SIM. 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 Yeah.
This one, right?
Yeah.
Right. So that's how it. So
Yeah, that's good.
yeah. So based on that, it will have to do. So how does it impact? It has a lot like AML, anti-money laundering, or FATCA, where foreign investments done by the entities or other than entities or customers other than the non-residence countries. So there's a lot that goes. So these only that's the reason any exchange will allow local residents itself. There are few organizations which will or few exchanges which will allow other countries also. So that's where the concept of investment banking is booming actually. The reason I have a banker who is reliable, okay. So I am not sure whether I can directly go into the exchange and do it. So how does, and say suppose, okay, let's not confuse him. I am a citizen of India, okay, and I want to buy stocks in USA. Now I don't know the rules and regulations of US exchange, okay, and keeping track of the changes or the loss is tedious. Okay, so this can be resolved by something called as broker. These brokers will know everything, or they will know how to do the trading in a different exchange or in the same exchange, and they are licensed to buy on the investor's behalf. Okay, so generally if you take in India, I have to buy in US, then I'll go to a reliable investment banker and will buy from them. Okay, now these investment bankers will buy on our behalf, stating because they are licensed to buy there, right? So any disputes will be handled by the investment. That's the reason they charge commission, which is called as brokerage, right? So brokerage is a big concept. Wait one second. Yeah, brokerage is a bigger concept, and there's a lot of money that goes into this. Okay, a simple example is in a given exchange in a day, almost 1 lakh, or say suppose in terms of US, almost 200 to 300 million dollars worth of trading happens, buying and selling. Okay, so every time someone buys or sells, it has to be done through broker, right? So they will get the brokerage for every transaction they are doing. So if you take a simple calculation, Generally they will charge 0.025% of the amount, right? So if you take for 200 million there, $200 million worst, so how much it would be? Somewhere near to $40,000. That's the amount of brokerage on an average in a day. The brokers will be earning, which is a huge amount, right? So that's the reason any investment banker, a correct investment banker, a genuine or an ethical investment banker will ask people to invest long, not for shorter duration. So it's a bigger concept again, but just for your information, the more the buying and selling, the frequency, right, the lesser will be the profits. Okay, so the advice to everyone is invest regularly and for long term. You do your general calculation. So, but just for your information, the more we do transaction, the more the brokerage firms will be earning instead of us. Okay, and for the profit to change overnight, any company will not earn profits, right? So its stock price will not boost or it will not jump. What do you say, in one day or one month? Okay, it's a gradual process. That's the reason. Carefully watch the stock price and then move ahead. Okay. Now there's a concept when we sell when we sell or buy, right? There's a concept called as execution. That's the technical term, which will uh, say that if the stock has been bought or sold and the transaction, which means the pay-in and payout is completed, that's called as the stock is executed. Okay, all right. So which means, example is, I have the 100 shares and I am selling it, right? When I sell it, the company has to pay the amount, right? It has to physically or it has to wire transfer the amount worth of my 100 shares. So shares are $200, say suppose now. So I should get $20,000 back into my account, into my savings account or current account. So only then it's called as the execution has been completed. Okay. Now there's something called as margin. Now I have only $10,000 and I foresee that the stock, which is $200 now, will go to $500 in 1 week. But I don't have, but I want to earn more profit, and I have limited cash with me. Okay, so what brokerage firm will do is, considering what is the past history, they will give few stocks on margin, which means it is lending you money to buy a stock and keep it for the said duration. For this, they will charge brokerage as well as utilization fee, right? So now simple example is, I want to buy 100 stocks at $200 $200, but I have only $10,000, right? So 100 stocks into $200 is 20,000, and I am short of $10,000, which means you have to lend money from brokerage of $10,000, right? So you are lending. For this, brokerage firm will charge the utilization fee, which will be somewhere around the regular, it will be more than the regular in what do you say, FD interest, somewhere around 15 to 18% they will charge. Okay, so that if you 15 to 18% is per annum, right, which is 1.5% per month, and if we would calculate by day, it would be somewhere near to 0.015% per day. So what's the amount which is lent? So that is $10,000 per day. It's 0.015%. So somewhere daily you will be paying $1.5 as utilization fee per day, right? So how is it advantage to both the brokerage as well as this the investor? Investor, if he is sure that it will go to $500, he is getting 100 stocks, 100 stocks, which means 50 stocks extra than what he was supposed to buy, right? So he had $10,000. At $200, he will get only 50 stocks, but he wanted to buy 100 stocks, which is 50 stocks extra. So for 50 stocks, if the profit is if it is going to $500, which is profit is $300. So what's the profit, net profit he can earn is $300 into 50, which is $15,000, right? Earlier he was just earning only $15,000, but now because of this he is earning another $15,000, right? Which is a profit for him. From brokerage point, they are earning $1.5 as the utilization fees. Earlier for brokerage they were earning only $2.5 for 10,000 transaction, but now as he is investing $1.5 extra, 10,000 extra which they are lending, they are getting $1.5 as utilization fees for the next 1 week. So 1.5 into 7 is somewhere near to $10.5. So instead of just earning $2.5, they are earning extra $10.5, right? So they are also not at loss. Understand? So that's how the margin concept works. All right. So far, any questions? Ram, Arti?
Okay.
Okay. Now there's concept called as portfolio. Portfolio is a list of stocks and an investor has in his account. Okay, so it can be of multiple stocks, like a cement based or a fertilizer based or an what do you say, IT stock. Okay, so his portfolio is not confined to one sector, or he or she can have stocks of different kinds of organizations, right? So the net stocks, the total list of stocks that particular investor having in his account is called as portfolio. All right. Now there's something called as day trading. This is like similar to stocks buying and selling, but what happens is the stocks can be bought anytime during the stock exchange is open, which is generally from 10 to 3:30 in US, I think. Whereas in India it is from 9 to 3:30. So during this time you can buy anytime and sell anytime. Okay, so that's called as day trading. Whereas normal stocks you can buy anytime in the day and you can sell anytime in the future. But here in day trading you will buy today and you will have to sell today, or you will sell today and buy today itself. Okay, it has to be completed. The transaction has to complete it today itself. Okay. Next, bull market. Bull market is something like when all the stocks are moving, in the sense it's moving ahead, then it's called as a bull market. Whereas bear market is when a majority of the stocks are moving or dropping down. When the share price drops of the majority of the stocks in that particular action, then that's called as bear market. Okay. Then this called as moving average. So if you see any stock will be trading every day, right? Say suppose on day one it is $200. Day 2 it is $205. Day 3 it is $204. Day 4 it is $200. Day 5 it is $190. Okay, so moving average is calculated summing up all these days amount divided by the number of days. So it would be somewhere around 201.75. So that's the moving average of the stock. So how does this help the investors is they will see what is the current trading price, and if it is more than a moving average and other factors, they will try not to buy this stock. Okay, but they can also buy considering other factors as well. But generally if someone is working is on the if is a cautious trader, right? So if it is more than moving average, then they will try to avoid that stock. If it is less than moving average, it is a good stock to buy. Conditions applies. It may be free falling in the sense that particular stock has lost its charm and no one is trying to buy it. So that might be the situation. So cautiously, this moving average will help you to understand what is the position of that particular stock. Okay, understood? Now, this comes to the concept called as rally. Rally is if a stock has rapidly increased, then from its moving average, then it is called as rally stock, which means that is the stock value is increasing than its moving average, or it's rapidly increasing from what it was there. Okay, that can be of the reason can be many things, like it has got a good profit, or someone gave a good business to them. Okay, or some future investment is happening, or some government norms have been freed up so that uh, more investors can come, or more exports can be done, so on and so forth, right? There are many ways where a stock will increase. So suddenly if some movement is happening, that's called as a rally. Okay, volume. The another concept is volume. Volume of stocks is in a given day how many shares have been transacted. It can be buying or selling, anything. So they will do a cumulative addition of these, and they will say this is the volume of trade that is happening in a given in a given day or a given market. Okay, so that's called as trading volume. All right. Volatility. This is a general term that will be used in stock market. So have you ever wondered why a stock price will change every second? See, in a given day, right? In a given day, you cannot have 10,000 or say suppose this exactly corporation is 14.32 at the closing time. Now, if you see, it went till 15.24 and came back, right, on the same day. Okay, or in a two, say, let's go for a one day itself. So in a given day, it started with 14.57 and then ended with 14.32, which means almost 3% of fluctuation from top to bottom, which is a heavy change, right? So why will a stock change in a single day or every second? Why will a stock price will change, right? So that's because there can be investors who are, if suppose it is increasing, more people are buying it. So that's the reason it is increasing. But at a given point, many people are selling it, it will go down. Right? So based on the buying and selling, the prices fluctuate in a given day. Okay. So if suppose a stock went up to $15, came down to 12, then went to 13, then came back to 11, then went to 16, and then settled back to 14. There's a lot of volatility in this particular stock. That's called as volatility. Okay. There's lot of fluctuations are there. Okay, the peaks, ups and downs are more. That's called as volatile market. Right? Okay. So we'll stop today. We'll continue tomorrow on this concepts, shares and stocks. Okay. Today we just discussed on the basics. Tomorrow we'll discuss the other concepts. Okay.
Okay.
Any questions?
No. Yes. Yeah.
All right. Fine then. So see you tomorrow again. Yeah. Thank you. Good night and good day.